Hey, this is just a quick trading video in regards to my thesis on crude oil. So, crude oil, in my opinion, right now is it's kind of being tug of war back and forth between $40 and $50. And the reason for that is that when it gets to $50, you really have all the U.S. shale producers coming online and they start pumping oil because it's now at the level of the price level that they can become profitable. But the problem with that is that once they start pumping oil, the market becomes oversupplied and we get an oil glut. And basically, what that means is that, it's simple economics, supply and demand. So that means that obviously, due to the oversupply and if demand isn't drastically increasing with that, obviously prices are going to get bearish and go down to match that level. And that's exactly what we have going on here, as you can see. So anytime it comes close to the $50 level and these producers come online, next thing you know, you have an EIA report or an API report saying, yeah, well, we had 10 million or 10 billion barrels of storage, or whatever the numbers are, and next thing you know, we were expecting this, and it turns out it was much greater, and everybody says, wow, there's so much oil in the market, it's ridiculous. Sell oil, because it's not going to go up anytime soon. And then you also have to consider OPEC and everything going on with them, but the reality of the matter is that they actually, in my opinion, I think are kind of cheering lower prices in oil. And you'd say, well, how is that? Don't they want to make money? Yes, they do, but they make more money in terms of the fact of market share versus the price of oil. So when it's at 50 or above, everybody's producing oil and making money, which means that they have a reduced market share because now America and everybody else is online selling oil. And that means that, yes, they're getting more per barrel, but they're selling a lot less of their oil because there's other producers online. Now it falls below 50, and guess what? It's no longer profitable for these companies in the United States to produce, so they all go offline. And guess what? Now there's nobody left to produce oil but the Middle East. So, in like Venezuela and other countries. But either way, in the majority of the OPEC nations. So, in that scenario, all the business goes to them. So it's 100% of profits versus other countries getting into the soup mix. And so essentially, we're in a tight range that I feel is not likely to get broken anytime soon unless one of two things happen. Either the Fed decides to hike interest rates, which obviously is going to increase the value of the dollar, and that's going to be very bearish for oil. And then it will break out of this range and potentially be back into a bear market like it was earlier this year, back in like February and January. And we could see this capitulating down into the $30, maybe even back into the 20s. Who knows? But it's going to be bearish nonetheless. The bullish theory would be that basically, it would be obviously something catastrophic essentially has to happen in one of these countries, and it's one of those kind of bets where it's like, I don't want this to happen, so I don't really want to bet on that it will, type of thing. And it would be one of really two things, in my opinion. It would be either that North Korea just gets out of control with their nuclear weapons testing, and next thing you know, they're dropping a nuke somewhere, or on the other side of the world, Donald Trump gets elected to the presidency, and he decides to start carpet bombing the Middle East and destroying oil wells and everything else, and therefore production gets halted. And obviously, because there's less production in the oil market, there's lower supply, and demand in theory would still be the same, if not higher. And then obviously the price is going to go up. So either way, both of those bets are very negative in my opinion, and I don't really want to be the guy that's sitting here kind of like betting on terrorism to make a profit. That's kind of a shitty thing to say or do. Anyway, in regards to the price of oil here, I mean, how you would want to essentially trade it is in options to make the most money. So specifically, I mean, you can look at my last week's call. Let's see here. Let's do the 20-day 1 hour. So last Friday, I basically said on Friday that, it's approaching that resistance level. there you go, that trend line that we've drawn here. I mean, it kissed it, and then that was all she wrote. But I basically said, yeah, so we're heading into the headwinds of the Federal Reserve meeting into this week, and then it's going to happen next week. But nonetheless, it's a classic Wall Street buy the hype, sell the news event, in my opinion. So what that means is that the U.S. dollar is going to be hyped up in anticipation of a Federal Reserve interest rate hike. And a strong dollar means a weak oil price. So as the dollar rallies, I mean, let's just, I said basically buy the dollar here and look at it now type of situation. But let's go back to crude oil. So obviously you have a inverse correlation in this situation, just as I said it would be. So I said sell oil here. So what you would have wanted to do is basically buy puts. And we have the 47.50 puts. So 47.50. You could have bought them at their cheap point at $1.90. And so essentially you're paying $1,900 per contract. Say you have a very small trading account and you only have like $4,000 or $5,000. And you're really confident in this strategy, and you decide, hey, I'm gonna place a bet. Maximum I can lose is my entire account if the options expire worthless, and all of my fundamental analysis that I've just outlined is completely garbage, and none of it's true, and it doesn't matter, and all of a sudden, things are happening outside of my realm of predictions. Obviously, that wasn't the case, but that's the worst case scenario. Just outlining that. Either way, this is what happened. Is basically we touched the trend line, and that was all she wrote, and it would have been a great bet. So if you bought two contracts, say you've spent $3,800 on two put contracts at $1.90. As of today, I mean, it looks like the price probably was higher, whether or not there was any trading being done at it, who knows? But down here, it probably was even at 450, maybe even that you could have been getting out of the trade. But nonetheless, even if you get out at 430, I mean, you're talking about going from a $3,800 account size to an $8,600 account size. So that's greater than a 100% return in 1 week. I'm sorry, but I don't know any hedge funds that are out there producing these types of returns. Most of them are like negative 20% on the year. And I'm telling you that in 1 week, you can have a 100% or greater return on your capital just by trading crude oil on these fundamentals. I mean, it's pretty cut and dry. Now, like I said, obviously, I mean, as it gets lower and lower, let's just look at strictly the technicals and take everything else out of the equation. And so, at least all the way back into June, we have this tight range. So, as this, I mean, you normally get like a down and then a slight dead cat bounce and then another down and then the next ramp up. So we have kind of gone down, and we're expecting a little bit more downward pressure, especially if the FOMC does come out and say we're not going to raise interest rates. That's going to be the catalyst for up. But oops, we don't have that news out yet, and in the meantime, we're still in the blackout period with the FOMC. So right now, everybody's kind of speculating, nervous, panic selling, whatever the situation may be. All of Wall Street is pretty much short selling crude oil since it was at these prices, because obviously they have a similar analysis to the markets as I do, or maybe something different. But either way, they said it's getting bearish at these levels, and they all shorted it, and they take a while to cover. So it's going to be a great rally once they decide to cover, but nobody's hitting the bid is my point. When you get these big down, I mean, you get the Fibonacci retracements, but that's about it. And then it's right back down. So I would look to honestly go long here at this trend line. So as we head into the FOMC meeting, I would say that you're going to want to buy the dip here at these levels, it looks like it's going to be about 42 bucks and maybe 42.50. So you're going to want to buy like the 42.50 calls. Now, because it's tough to really say, I mean, honestly, I'd say maybe go half your size at the 42.50 calls. So here we are. Let's narrow this down. So this is November. So the hell? Well, apparently they're trading at like 250. I don't know what this 10 cents 510 spread is all about, but I guess that gives you an idea of where things can go. They can either go to 10 cents or they can go to 510. That's where the big predictions are at for the extremes of the market. This is kind of after hours, so you're not getting active spread action. But either way, clearly this is not getting much attention by Wall Street. It's the least traded option within an eight price strike range. And that to me means blood in the water type of situation. Like, hey, I'm a shark. I'm looking for the best opportunities. Clearly, everybody's ignoring this one. And that's something that I like to take a look at is when everybody else is ignoring it. That usually means it's a solid bet. 9 times out of 10, believe it or not. So in this case, if it's at $2.50 now, guess what? When oil's now at $45, $46 after the Fed says we're not going to raise interest rates, and all of a sudden the dollar tanks in value because it's a classic buy the hype, sell the news. So everybody's going to sell the dollar, and commodities will rally. And I mean, you can look to make a solid profit here on this. If you're long now at 250, boom, you're making even more money. But I would wait again because prices are obviously going to keep dropping. I mean, you're definitely going to find that bid at 40 to 41, but yeah, so I mean, you're going to want to wait a little bit. If you can get these call options at like $1.50-ish level, like one of these levels, like an in the money kind of call, even at $2 really, you're gold. I mean, you're going to double your money again holding them. I mean, and you have all the way till October 20th to sell them for a profit. So it's a solid swing trade, and you're going to make a shit ton of money. Mark my words. If you don't, you can personally sue me because I'm that confident. Yeah, so that's my market thesis on crude oil.